Would you believe me if I told you that Warren Buffett, one of the richest people on the planet, legally pays a lower tax rate than his secretary? Well, it boils down to a simple fact. There are two kinds of taxpayers in this world. There are those who see taxes as just another unavoidable part of life. And then there are those who understand how to legally minimize what they owe through financial literacy and smart strategies. In this video, we're going to pull back the curtain on how the wealthy really think about taxes. We'll explore 7 powerful methods they use not just to protect their money, but to grow it. By the time we're done, you'll understand the exact financial frameworks that people like Warren Buffett, Jeff Bezos, and other successful entrepreneurs use to legally pay less tax and keep more of what they earn. To make this crystal clear, let's meet our 2 examples. First, we have Paul. We'll call him the willful taxpayer. He simply accepts his tax bill and pays whatever the government asks. No questions asked. Jack is a business owner who uses his financial know-how to legally reduce his tax burden and build his wealth. Let's start with Paul. He's a hard worker, earning about $40,000 a year. Every single year, without a second thought, he hands over nearly $15,000 in income tax. He works, he earns, and the government takes its cut. Now, let's look at Jack. He runs a growing tech company with over 50 employees. He's paying every kind of tax you can imagine: income tax, property tax, sales tax, excise tax, and investment tax. Why am I giving away such a massive chunk of my hard-earned income when there are legal methods to minimize it, just like the big corporations do? This single question sets Jack on a journey. He decides to learn the tax secrets of the rich, and what he discovers is a set of 7 powerful methods that will completely transform his financial future. The first secret Jack uncovers is the power of writing off business expenses. You see, when you're an employee like Paul, your income gets taxed, before you even see it. Your paycheck arrives with the taxes already taken out. But when you're a business owner like Jack, the game is played differently. The business pays its expenses, and you're only taxed on the profits that are left over. Imagine Jack's digital marketing agency brings in $200,000 in revenue this year. Now, let's say he spends $100,000 on legitimate business expenses, things like software subscriptions, new laptops for his team, the office internet bill, travel to meet clients, or even rent for his workspace. All of these are necessary costs of running the business. Because he spent $100,000 on expenses, he now only pays taxes on the remaining $100,000 of profit. And here's the real kicker. Many of the expenses that help you improve your business, like attending industry conferences or going on trips for professional development, can also be written off. This is a big reason why entrepreneurs often seem to live a richer lifestyle. They're not just spending money, they're investing in their business and legally reducing their tax bill at the same time. Next, Jack learns that the world's biggest companies, like Amazon and Apple, legally save billions of dollars by strategically moving their income through countries with lower tax rates. This is called diverting income overseas. Some places, like the Cayman Islands, are famous for this. They have 0 income tax, 0 capital gains tax, and 0 estate tax. Think about that for a second. If Jack's company were structured to earn $5 million and legally declare that income in the Caymans, he could potentially keep all of it instead of paying a 30 to 35% tax rate in the US. On top of the tax benefits, setting up offshore companies can also offer greater banking privacy and have fewer reporting requirements, which makes them incredibly attractive for businesses all over the world. Now, of course, it's not practical for every small business owner to just pack up and move their entire operation offshore. By understanding global tax laws, even small entrepreneurs can find ways to structure their businesses more intelligently, to take advantage of different tax jurisdictions legally. The third method Jack discovers is a real game changer: learning how to make even losses work in your favor. Here's a secret of the wealthy. In the world of business, even a loss can be profitable from a tax perspective. But those financial losses don't just disappear. They can be carried forward to future years when the business becomes profitable. So, when Jack's company finally has a breakthrough year and starts making a real profit, he can legally deduct the losses from his early years from his current earnings. This is a powerful tool called loss carryforward, and it's one of the key strategies that allowed companies like Tesla and Amazon to pay very little or even 0 federal income tax during their biggest growth phases. They weren't cheating. They were using the tax code exactly as it was designed, reinvesting every dollar back into growth and using past losses to shield future profits. As Jack's company grows, he needs to attract and retain top talent. Instead of just offering bigger and bigger salaries, he adopts a 4th strategy used by many successful tech companies: issuing stock options. Why is this so smart? From an accounting perspective, granting stock options is considered an expense, which reduces the company's taxable profit on paper. But here's the brilliant part: it doesn't actually cost the company any cash up front. So, Jack's business looks less profitable to the tax authorities, which lowers his tax bill. At the same time, his employees are now part owners of the company. They have a direct stake in its success, which gives them a powerful incentive to work harder and help grow the company's value. It's a true win-win situation. The employees are motivated, the company saves cash, and Jack keeps more of the profits. This is the exact playbook used by giants like Google, Tesla, and Facebook to reward their teams and create a culture of ownership. It's how many of their early employees became millionaires. After running his business for several years in California, Jack gets tired of paying the state's high income tax, which can be as much as 13.3%. This leads him to his fifth strategy, leveraging geographical tax laws. He starts researching states in the US that have no state income tax at all. He finds a list of places like Texas, Nevada, and Florida. By simply relocating his home and potentially his business headquarters to one of these states, Jack can legally save over 13% of his personal income every single year, without changing anything else about his business operations. This is an incredibly common strategy, especially for retirees, remote workers, and digital entrepreneurs who have the freedom to live and work from anywhere. It is a simple move that can add up to hundreds of thousands of dollars in tax savings over a lifetime. The sixth method Jack dives into is one of the oldest and most reliable wealth-building tools: investing in real estate. Real estate isn't just a great investment, it's one of the most tax-efficient investments you can make. When Jack buys a rental property, he's not just earning passive income from the rent. He also gets access to a whole host of massive tax deductions. He can write off the interest he pays on the mortgage, any money he spends on repairs and maintenance, and most importantly, he can deduct for depreciation. Depreciation is an accounting concept that allows you to deduct a portion of the property's value each year, even if the property is actually going up in value. This paper loss can be used to offset his rental income, significantly reducing his taxable income, and it gets even better. When it's time to sell a property that has appreciated in value, Jack can use a powerful tool called a 1031 exchange. This rule allows him to sell a property and reinvest all the profits into another similar property within a certain time frame, usually 60 days. By doing this, he can defer paying capital gains taxes on the sale indefinitely. He can keep rolling his profits from one property to the next, growing his portfolio tax-free. This is one of the main reasons why the rich just keep buying more real estate. It's both an income-generating machine and a powerful tax shield. Finally, Jack learns the art of deferring income. This seventh strategy is all about controlling asterisk. When asterisk, you pay taxes, not just how much. The primary way to do this is by using retirement accounts like a traditional IRA or a solo 401k for business owners. When Jack contributes a portion of his income to one of these accounts, he gets an immediate tax deduction. That money is subtracted from his taxable income for the current year. He'll only pay taxes on it many years later when he withdraws the funds in retirement, at which point he'll likely be in a lower tax bracket. Let's look at an example. If Jack earns $500,000 this year, instead of paying a high tax rate, say 40%, on all of it, he can contribute the maximum amount allowed to his retirement account. That contribution immediately reduces his taxable income, potentially saving him thousands of dollars in taxes this year. This strategy allows him to control his financial destiny by deciding not just how much tax he pays, but when he pays it. So, at the end of the day, what's the real difference between Paul and Jack? They both earn money through hard work, but they use their money in fundamentally different ways. Paul works for his money, and then he pays taxes first, living off what's left. Jack has learned how to make his money work for him, and he pays his taxes last, after he has strategically invested and grown his wealth. The truth is, legal tax avoidance isn't about being sneaky or cheating the system. It's about understanding the system better than most people do and using the rules that are available to everyone. The tax code is full of incentives designed to encourage certain behaviors, like starting a business, creating jobs, investing in real estate, and saving for retirement. The wealthy simply learn what those incentives are and build their financial strategy around them. So, the question you should ask yourself is, which path will you choose? Will you be like Paul, who passively accepts his tax bill as an unchangeable fate? Or will you be like Jack, who actively seeks out knowledge and uses financial strategy to build a better future? If you found this breakdown valuable, please give this video a thumbs up, share it with a friend who needs to hear this message, and be sure to subscribe for more insights on money, business, and achieving financial freedom. Thanks for watching, and remember, it's not just about how much money you make, it's about how much you keep.